Have you ever really stopped to think about why things cost what they do? Like why a coffee is $3 or why a flight price can literally change while you're looking at it. It feels kind of random, but it's not. It's actually this invisible dance between two huge forces that pretty much run our world. So let's pull back the curtain and see what's really going on.
You know the feeling, right? That brand new gaming console, those concert tickets that sell out in a nanosecond, the limited edition sneakers that are just gone. It's super frustrating. But that exact feeling, that's actually our first clue. It's the key to understanding the secret language of the market. It's the first half of our whole story.
So, to figure this whole thing out, we have to start with the most important person in this entire equation, you. Yep, you. Your choices, what you want, and what's in your wallet, that's what kicks this whole thing off.
Okay, now economists have a pretty formal name for this whole idea. They call it the law of demand. I know, it sounds a little dry, a little academic, but trust me, the concept behind it is something you live and breathe every single day.
And really, it just boils down to this super simple idea. If your favorite coffee shop suddenly doubled the price of your latte, you'd probably buy it less often, right? But what if they had a half-price sale? You might even treat a friend. It's just common sense.
Of course, it's not just about the price tag. Other things can shake up our buying habits. Like if you get a big raise, you might start buying more of everything. Or if something goes viral on TikTok, suddenly everybody wants one, and demand just explodes. These things are always shifting our collective desire.
And if you were to actually plot all of this on a graph, you'd get this. You've got the price going up the side and the amount people want to buy along the bottom. The result is this clean, downward sloping line, the demand curve. It's the perfect picture of this idea. As the price goes higher, the quantity people want goes lower. It's piece number one of our puzzle.
All right, so that's us, the buyers. But that's only half the story. To get the full picture, we've got to flip the script and look at it from the other side of the counter. What are the people making and selling this stuff thinking? Well, they're playing a completely different game.
They have their own guiding principle, and it's called the law of supply. And if you look at the definition, you'll see it's basically the mirror opposite of what we just talked about with demand.
So for them, here's the bottom line. It's all about profit. If a company can sell a product for a ton of money, you better believe they're going to be motivated to make as much of it as they possibly can. But if the price people are willing to pay for it drops, well, it might not even be worth their time to produce it anymore.
And hey, just like we did with demand, we can map this out. This gives us the supply curve, and you can see it's an upward sloping line. As the price goes up, the quantity that companies are willing to supply also goes up. So now we have both of our key players on the board.
Okay, let's take a breath. So we have us, the buyers, wanting low prices, and we have them, the sellers, wanting high prices. These two goals are in a total head-to-head conflict. So how does anything ever get bought or sold?
The best way to think about it is like a giant, constant tug of war. Our demand is pulling the price down. Their supply is pulling the price up, and they are battling it out all the time for every single thing you can buy.
So what gives? Where does this tug of war finally end? How does the market settle on one single price that kind of works for everybody?
The battle stops right here, at the exact point where our two lines cross. This beautiful little intersection is called equilibrium. It's the magic price. It's the market's sweet spot, where the amount of stuff that we want to buy is exactly the same as the amount of stuff sellers are willing to make. Balance.
And you can immediately see what happens when the price isn't at that sweet spot. If the price is too low, you get a shortage. Bam! That's your sold-out gaming console. Way too many people want one, and there just aren't enough to go around. And if the price is too high, you get the opposite. A surplus. Warehouses full of stuff just sitting there collecting dust, because nobody wants to buy it.
Now, for centuries, we humans have been trying to find this equilibrium point, mostly through a messy process of trial and error. But today, a brand new player has entered the game, and it can find that sweet spot with almost scary precision.
Yep, I'm talking about artificial intelligence. AI is completely changing this game. It can sift through mountains of data to predict what we're going to want before we even know it. Then it can tell factories and shipping companies exactly how much to make and where to send it. And finally, it can adjust prices in real time to find that perfect equilibrium, instantly.
Now, this is really important. AI isn't throwing out the laws of supply and demand. It's not rewriting the rules, it's just mastering them. It's playing the exact same game, but it's doing it faster, smarter, and more efficiently than any human mind ever could. It's the ultimate market player.
So this all leaves us with a really fascinating and kind of huge question for the future. If AI can create a perfectly efficient market where shortages and surpluses are a thing of the past and the price is always just right, what does that world look like for us, for our choices, for what we decide something is worth? It's definitely something to think about.